If you do not know how to increase your capital, but you really want it, you have come to the right place. Now I will tell you about what helps me to increase my capital. Compound interest, or capitalization of interest, is the accrual of interest not only on the original amount but also on the interest accrued over time. In other words, it is the gradual addition of accumulated interest to the principal amount for further interest accrual. A perfect example of compound interest would be Warren Buffett's table. When telling his partners about the power of compound interest, Buffett cited the following table showing the returns from capitalizing $100,000 in interest over 30 years at rates ranging from 4% to 16%. Take a moment to take in these numbers. Go through them from left to right starting at the top row and linger on the figure in the right column of the last row. Notice the huge financial advantage of long-term investing and the huge advantage of high rates of return. If you can combine the two, the result is mind-boggling. Capitalizing interest at a 16% annual rate turns $100,000 into $5 million in 30 years. If you are 20-30 years old now, definitely start investing. If you don't know what to invest in, I will dedicate a whole issue to this topic. Just write about it in the comments, and it will not be typical ways of investing. Where to start your investor journey? How can you come into a large capital if you have only $10,000 in savings? How not to burn out with such a long investment period? I'm going to tell you some tips that I follow myself, and I've been investing for 7 years now. First of all, you need a goal. For example, in 15 years to have a capital of $1 million. To set a goal correctly, you need to start from the end. You need to have a picture in your head that will show you how to get to the result. For example, I want $1 million in 15 years, but I only have $10,000, so I need to increase my capital 100 times in 15 years. How do I do this? Next, we begin to sort out the options, a high-risk business or investment, or a low-risk business or investment. Based on this, we begin to count. If I invest $10,000 at 15% per annum in the same S&P 500, with an average yield of 16% per annum, will I reach my goal in 15 years? The answer is no. This is impossible without additional investments. But if you invest another $1,000 per month for all 15 years, then you will have a capital of $847,000. When setting a goal, you should have a complete understanding of what you need to come to and how to do it. Which sources will help you with this? The road to big capital is built with the right investment and, of course, cold blood. To do this, I recommend reading a book by Carl Richards called The Psychology of Investing. How to Stop Doing Stupid Things with Your Money, and also this book is on our second channel, where we release books in audio format. In stock market speculation, composure and a cool head are very important. Emotions should be immediately excluded. For example, I will tell the story of my very close friend who a year ago, without the right knowledge, got into the cryptocurrency, watched some video tutorials on YouTube, read the advice of non-real traders, and lost $110,000 in January 2023. For someone, the amount is insignificant, but he went to this money for 5 years, saving a little bit and launching various business directions. That's why a clear analysis of the investment niche and a cool head. Put aside all emotions when setting a goal. And now I'll tell you how not to burn out, because I went through all these stages. And so, we decided on a goal, we resorted to cold blood, and the question remains how not to burn out, because building up huge capital is a lot of time. Just imagine that you need to invest money for 15 years and not spend it. When I started investing 7 years ago, I started with $100 because I did not have a lot of capital. When in the first year I managed to make more than $1,000 out of $100 through stock speculation with cryptocurrency and took all the money and spent it, while my friend, who started with the same budget, I made $4,500 for the next year, and I left my $100 again and was able to make only $600. I spent money on nonsense that I wanted to get here and now, and immediately dismissed the idea of my future, which was my main mistake. I didn't think at all about the fact that for a whole year I invested and speculated, lost and earned, and eventually I started with $100 again. This concerns the issue of your emotions. If you are ready to invest some amount, you must understand that it will not harm your life. You need to invest the money that is easier for you to part with, and they will not play a big role in your life. For example, I now work as a manager in a small production. My salary per year is $80,000. For all my living expenses and for a small business in which I invest very little money, I spend about $65,000–70,000 a year. The rest of the funds I invest in stocks and in short-term projects. For example, I have another YouTube channel that I spend about 5 hours a month on, and it brings in around $250–300 monthly. It's not enough, you say, but the cost of my hour of work is estimated at $50–60, which is generally not bad. After all, the same teacher, somewhere in California, earns around $30–40 per hour. Let's summarize the interim results. You and I have roughly figured out how to come to a lot of capital and how to manage our emotions. By the way, Warren Buffett has repeatedly talked about all this. Now we need to understand which sources are worth investing our time and effort in. There are several sources for investing, and the choice of source depends on individual preferences, risk tolerance and investment goals. Bonds are considered the safest way. Investing in bonds can be a good way to diversify your investment portfolio and generate income. Bonds are fixed income securities that represent a loan from an investor to a borrower, usually a government or corporation. When you invest in a bond, you are essentially lending money to the issuer in exchange for periodic interest payments and repayment of the face value of the bond on the maturity date. There are several types of bonds, including government bonds, corporate bonds, municipal bonds, and international bonds. Each type of bond has its own risk and return profile, and it is important to consider these factors when choosing bonds to invest in. One of the main advantages of investing in bonds is the regular income that they can provide by paying interest. Bonds also tend to be less risky than stocks, which makes them a good option for conservative investors. In addition, bonds can provide stability and portfolio diversification, as they often have a low correlation with stocks. When investing in bonds, it is important to examine the creditworthiness of the issuer, as well as the maturity date of the bond, the interest rate, and any reserves for repayment. It is also important to consider factors such as inflation, changes in interest rates, and the general economic environment, as they can affect the value of your bond investments. Investors have the option to buy individual bonds or invest in bond mutual funds or exchange-traded funds, ETFs, which can provide diversification and professional management. It is important to carefully consider your investment goals, risk tolerance and time frame before investing in bonds, and consult with a financial advisor if necessary.